which the management accountant partakes or plays within an organisation. This webinar is relevant to the subject managerial finance part of the professional one examination suite. In terms of the decisions that an accountant, the management accountant in particular, may have a part in playing, there will be many, and these decisions are typically critical to the onward success of a business. I would go as far as to say that if we make the right decision at the right time, we should go a long way towards ensuring business success. Let's talk briefly about what some of those decisions may be. For example, say we have the pricing decision, ensuring that your product is appropriately priced in the context of competition, in the context of economic conditions, and in the context of ensuring that a sufficient margin is being delivered to the business. A critical decision in any business, one would have thought. There's another decision pertaining to the outsourcing choice or decision. Do we make ourselves in-house, or do we go outside and buy that particular product or component, as the case would be? Another decision we might find in the context of a process costing environment is, do we further process? So do we take perhaps a product at the point of separation, and then do we further incur costs in order to generate additional incremental revenues, and whether or not that is financially worth doing? There are decisions regarding, do we launch and when do we launch a product or a service, and indeed at what point in time may be appropriate for us to withdraw a product or a service from the marketplace. Many decisions revolve around one-off short-term decisions where we're offered a one-off piece of work for a given price, and we need to determine whether or not it will be acceptable or it should be accepted. Other decisions include, do we work extra shifts or fewer shifts? Do we open up new facilities, or do we close down facilities, the case would be? And then of course we have where we have a limiting factor or a constraint. The question would be, to what extent do we maximize or optimize the use of that particular constraint? That's a rather interesting area, and where we have one constraint only, we will use the golden rule, whereby we try to maximize the contribution per unit of limiting factor. And then where we have more than one constraint, we might move into the whole area of linear programming, be it the graphical or simplex approach to optimizing the use of such limited constraints. Just to contextualize the decision-making process, invariably, the management accountant will, in the first instance, carry out a detailed quantitative or financial analysis of the particular decision at hand. And indeed, that is what the management accountant is paid for, is to bring that financial skill and objectivity to the decision-making process. So once tasked by the board of directors to carry out that analysis, it's the management accountant's role to discern what information is appropriate, is relevant, and thereafter to carry out that detailed technical analysis. Once completed, that will be presented to the board of directors or the decision-making body, the results of the quantitative analysis. And essentially it will involve arriving at a bottom line, a figure which suggests the benefit or cost of the decision to the organisation. The three critical words to concern yourself with when making one-off decisions is to apply the general rules of future incremental cash flow. I'd like to spend a moment on talking to you about that. Future means that at the point of making the decision, only those future cash flows are relevant. It's very important to appreciate that anything in the past which has been spent or committed is irrelevant to a decision at that point in time. The word incremental refers to change. We're only interested in costs and revenues which will change as a result of the decision. If there is no implicit change in a given figure, well, clearly we can exclude that or ignore that for decision-making purposes. And finally, we're only interested in cash flows as they pertain to a decision. Therefore, it's important that students look out for any, let's say, anomalous or non-cash items in the information given, and that would typically include the likes of depreciation are notional charges or notional income, as the case would be, which indeed will never transpire or eventually become a cash flow, be it an inflow or an outflow. So the accountant then presents the quantitative analysis, and in my experience it involves presenting a paper to the decision-making body, being available to answer questions on the technical financial analysis, and thereafter the wider debate will ensue. This will involve all parties to the decision-making process, discussing both the financial ramifications as presented in the previous report, and indeed to consider the wider issues or qualitative issues which pertain to the decision to be made. And in exam questions, this very much comes out in the structure of exam questions in the whole area of decision making. Typically, the first part of the question involves the detailed technical financial analysis, and thereafter, typically, the second part will also expect the accountant or student to be able to consider and discuss and debate what the wider issues might be. What are those wider issues? Well, really it's about deciding and discussing the potential impact of that decision at hand to the various stakeholder groups within the organisation. We'll talk about those stakeholder groups in a moment. Then, at that point in time, the decision-making body, stroke board of directors, should ideally be in a position to make the decision to decide whether or not to implement or launch a product, for example's sake, to work an extra shift, to withdraw a shift. They may decide on the appropriate pricing for a particular product or service, and thereafter it's about making the decision, making that decision known throughout the organisation, and ensuring that that decision thereafter is implemented. Then we have the follow-up, of course, to ensure that the results, the financial results as expected, do actually ensue or they actually materialise thereafter. So there must be a control element once the decision has been implemented at that point. Now, we talk generally about the three broad principles in short-term decision-making being you're only interested in future incremental cash flows. That's rather helpful. But in the law, there may be general legal principles which are enshrined or which are illuminated by specific case study histories or decisions. You could almost say the same for decision-making. When you are making decisions, when you're looking to understand the relevant costs and revenues, there are a number of individual rules which can be used as guidelines to help you through the technical analysis, as the case would be. And these rules are as follows. Some costs, which are costs which have already been incurred or in the past at the time of making a decision, these are always irrelevant. As the man says, they could be considered milk well and truly spilt. Any past costs incurred or revenue streams generated must be ignored at the time of making the decision, on the basis that they are in the past. Likewise, committed costs, which are rather similar to sunk costs insofar as they have been committed, but perhaps the cash has not changed hands at the point of making a decision, these are also irrelevant, on the basis that they are non-incremental, because if one is already committed at the time of making the decision has no impact upon that particular commitment. So we ignore committed costs on the grounds of they are non-incremental going forward. The classical cost behaviour of fixed costs are generally considered irrelevant because, as you probably are aware, fixed costs should not change with extra volume or extra pieces of work. So unless there's an increment or a movement up or down in fixed costs, generally they would be irrelevant to the decision-making process. So they're generally irrelevant unless the decision involves the stepping up or down of fixed costs. And please be aware that if that is the case, that it is the full step up or the full step down which is relevant to that particular decision. Variable costs, which vary directly with activity in the purest sense, are generally relevant because they typically would be considered to be an incremental cost. factors, particularly one limiting factor, it's very important that we ensure in making the decision that the opportunity cost, in other words, the income or contribution foregone, by using that factor for the purpose of the decision at hand, will be a relevant cost to the decision. So if you're passing up an opportunity to make this particular decision, that must be included within your costings. That probably is one of the more difficult technical concepts to appreciate, but it's very important that we do so, the concept of opportunity costs. Where we have stock on the shelf, and that stock is proposed to be used for a particular piece of work on which you're making the decision, there are interesting and important rules to apply in this context. First of all, if you're going to replace the stock, so you're going to take it off the shelf for the purpose of your piece of work or proposed piece of work, and it's going to be replaced, in that case the relevant cost will be the replacement cost. Irrespective of what the initial or original cost was, it is the future incremental cash flow, in other words, how much one must pay going forward to replace that item of stock. Please be aware, it may be significantly higher than the original cost or significantly lower than the original cost. But the critical point is it's the replacement cost which is relevant to the decision. What if there's a piece of stock which was proposed to be used for the decision, but it may not have to be replaced? And how one would know that, of course, in an examination would be where it refers to the fact that it's been in stock for some time and it is not in regular use. So one is not going to replace it. How do we determine the relevant cost thereof? Well, first of all, if there is no other economic value associated with that piece of stock, the relevant cost will be nil, insofar as it never has any future value to the organisation. It's already been incurred as a cost, so it's sunk, so therefore we can simply use that stock for the purpose of the proposal with no relevant cost implication. However, what if there is a other economic value associated with that item of stock? For example's sake, if it could be sold for scrap, or indeed perhaps it might be used in replacement of another piece of similar item of stock. Well, quite simply, the rule to invoke there is that the relevant cost is the higher of those two uses. If indeed there is two, there may only be one, in which case that will be the relevant cost of using that particular item of stock. I do think that those rules are very important for students to understand and to apply. And in examinations, it's important that you have that technical ability to discern which costs are relevant and which are not. A good example of such a question would be a question called AMT Limited, which is question 5 of the August 2008 paper, which involves a make or buy decision in essence, and the student has to look at the cost of internal purchase, or my apologies, internal production, as opposed to a external price which has recently been quoted. A good question to enable you work through those relevant costing principles. Now, as we know, the financial or quantitative analysis is important. Nevertheless, there will always be a wider implication of a decision, and these are broadly referred to in exam questions as qualitative factors. And when we're sitting around having discussed the financials, we might then want to look at those wider factors, those stakeholders that can be impacted upon by the decision, be it adversely or positively or favourably, as the case would be. Who will we consider in that discussion? We will want to consider customers. What does this mean for customers? Or if we're withdrawing a product, it may be a particular problem for customers, and vice versa. We might want to look at suppliers. If we're going to take on more business, that may be good news for our suppliers insofar as we're providing them with more opportunity, and vice versa. Likewise, employees, we may be providing additional work. We may have to leave people off, unfortunately. We may be able to use employees who are currently idle to make their day, let's say, more fulfilling. There are lots of factors pertaining to the provision or otherwise of employment which might be considered. We need to consider the impact upon our local community. If we are opening up a new factory, working extra shifts that will probably have a knock-on spin-on effect to the local community in a positive sense and vice versa. We might want to think about the impact of government. We might want to think about legislative requirements in relation to the decision. We might want to think about what the decision means from a public relations viewpoint. When word gets out of the decision, whereby we're opening a new factory or closing a factory, what impact that will have on the PR pertaining to this company. And then finally, of course, we might want to think about the CSR or corporate social responsibility issues or angles pertaining to the decision. Essentially, are we doing the right thing or not? And we could debate that, as the case would be. So it's important that the management accountant and you as a student, as you prepare for this managerial finance paper, that you're able to firstly carry out a technical analysis which will be required of the management accountant in the first instance, and thereafter to be able to partake in the broader decision-making process, because as we know, as accountants, we don't live in our own bubble. We need to actually get out there and in the real world and integrate and discuss issues